How are we doing out there? Okay. All right, let's get started. Ed Ponsi here on behalf of FX Street. Once again, welcome back to the show. It's our second of the day and our sixth of the week, our last of this week. I won't be here with you next week. I'll be down in Washington, D.C. Going to get this whole thing with North Korea all straightened out. So I'll be back. I'll be back the following week. I just got to throw a little muscle around. We'll get everything back in line. Anyway, let's get to some charts. And now I'll be down there with the Online Trading Academy teaching a class in Vienna, Virginia. Lovely place. Hope it's not too warm, but looks like the weather's going to be good. So it should be a good time. Should be a good week. And I'll be back the following week. And then it's off to vacation at the beach for a week. So let's get started. Take the fire and the fury with you. There you go, Carlos. Excellent. All right, let's get back to the charts. I wanted to go to the S&P 500, which is just stuck. You saw the big gap down yesterday. I guess folks were getting a little bit panicky about the international situation that we were just sort of alluding to right there. But then you can see how we gapped down and then rallied back toward the close, almost filled the gap, right? So so you could see that we closed here, bottom of the body. Gap down, and then rallied back, almost filled the gap. And if we, and then you look at today, kind of gloomy, a little cast a little bit of gloom and doom on the situation there. Big red candle to start your day there on the ES. And what does that normally mean? That normally means yen strength. So, what are we going to allude? What are we going to attribute this to? Let's take a look at the economic calendar here. We had a bunch of data hit. First of all, look at these numbers on inflation. Look at the Fed. Remember how the Fed always sees inflation coming down the road for like the last 10 years now, but it never gets here? Once again, it's still not here. Producer prices negative for the month of July, negative 0.1. But then you take out food and energy, and it's still negative 0.1. So producer prices turn negative for July, and that throws the whole annual numbers off below their expectations. And how can you raise interest rates again? I think you're done for rate hikes for the year, ladies and gentlemen. Once you start having negative figures, it's kind of hard to see how you're going to get to rate hikes for the Fed. Just doesn't seem possible. So PPI negative, and then the core also negative, which means it's not a fluke. Now listen, it's just 1 month, so let's not get too excited. It's just 1 month. But if this keeps up, it's hard to see how you could raise interest rates again. Here you've got the Fed raising rates and inflation going negative, and the Fed saying, well, it's down the road. And they've been saying that for almost 10 years now. And they've always been wrong. They've been wrong every single time. It never gets here. It literally never gets here. At what point are they going to figure out that whatever they're seeing down the road is some kind of mirage? And guess what, folks? The world's different now. I mean, Amazon.com, right? Things are different. The internet changed things. Whatever models they're using must be obsolete, right? Must be. Jobless claims were very close to expectations. So even though they give that red, we're going to say that's pretty much in line with estimates. You're coming in at around 240,000 every week, and that's pretty darn good. And by the way, job openings are the highest they've ever been in the U.S. The problem is, you've got to have people have to have the skills to fill the jobs that are available. That's the tricky part, isn't it? Right? So anyway, now what's the result of this? If we're not going to raise interest rates, what does that do to the dollar? Higher interest rates mean stronger currency. But if it's obvious that we're not going to raise interest rates, or let's just say it's not obvious, but let's just say it got a little bit harder to raise interest rates due to this PPI number, what probably just happened to the dollar? The dollar probably just fell. And that means the euro probably just went a little bit higher. Give you the 5-minute chart, give you the 5-minute treatment here. And there's the number. Boom, you see the big green spike right at 8:30. It looks like it's giving it back, right? We saw the euro jump 20 pips on that number. The pound should have jumped on that number as well. The Aussie should have jumped on that number as well. They all should have jumped on that number, right? And Aussie, I show holding the gains. Euro is not. But look at the pound jumped up pretty nicely, and then gave it back. Most of it still hasn't given it all back, but most of it. Pound sitting right at 130. Aussie's holding the gains for some reason. I wonder if that's trying to tell us something. Aussie's hanging in there, and has not. So euro gave them back very quickly. Pound gave back about half the gains, but it's like trying to hang on. But Aussie, come on, TradeStation, come on. Everybody in the world's lining up their TradeStation. Aussie's hanging in. Look at Aussie hanging on. Aussie's trying not to let go. Dollar CAD. Carlos is saying take a look at dollar CAD, so I'm going to take a look at dollar CAD here. And so, yeah, we've seen some pretty big movement here because this goes against the dollar strength that we've seen over recent days. We saw a nice bounce over the last few days based on the dollar index hitting 93 and getting a nice bounce off of support. But now, right, you just pulled the rug out from under the Fed. I don't know how you're going to raise interest rates now. Right? Yeah, look at the Looney just getting wrecked here, right? And a good 50 pips and really no bounce at all here on Looney, right? Which had been moving up quite nicely. So this is kind of a counter trend move for a lot of these pairs. Right, so, all right. So there you have it, right? A lack of inflation this could be the chance, right? This could be the counter trend move. This could be the rally in New Zealand USD and pound USD. Maybe this creates the move higher that we need to sell short. It's possible. I'm going to take a hack at pound dollar near 128.80 back to the mid-range 138.31. What do you think? Okay, now that might work, but the first thing I'm thinking is we're getting this little counter trend rally right now, and you can see cables like turning green here on the daily a little bit. The first thing I'm thinking is, boy, oh boy, if this hourly can come up, maybe we can get a little short covering rally here, and maybe we can get overbought on the hourly. Maybe, I mean, I know that's asking a lot, but maybe this kicks off a move here that can result in an hourly overbought, and I can short it. So I guess we're kind of thinking the opposite here. But You're thinking if it falls more, I can buy it. I'm thinking if it rises more, I can short it. So we're kind of at the opposite ends of the spectrum on this one. And if it comes to 131, even if it's not overbought, I would short it because of the resistance up there, right? You've got longer term resistance up there, and you can see it on the shorter term chart too. There's this used to be support right here, so it's resistance now. This used to be support right here, so it should act as resistance now. And so 131, I'm saying, come on, bring it up, because I want to smack it back down. And you're saying, bring it down, because I want to buy it and push it up. So we're basically looking at it two separate ways, but it's kind of but nobody wants it where it is right. Nobody wants it right here. I want it higher to sell it. You want it lower to buy it, but nobody wants it here. Isn't that interesting? So you're looking at 128.80 to buy. I'm looking at 131 to sell. Interestingly enough, you would get out of your long at 131. I want to short it at 131. I would probably get out of my short. Well, I had this area in mind before, right? Which is around 129.35. But now this new support has formed here. You see this right here? And it's a little bit higher. It's closer to 129.50. It's a little bit above 129.50. So that now becomes a new target. And that wasn't there before. That simply didn't exist until yesterday yesterday afternoon, it began to form. So I don't see anything wrong with what you're doing. We're just playing it two different ways. I want it to rally so I can sell it. You want it to fall so you can buy it, but nobody wants it in the middle. And that makes sense to me. But I still like the idea of selling it. I still prefer to sell it over to buy it, Carlos, because, again, the velocity of the move on the daily, not over the last few days, it's stabilized, but I mean, this selling was pretty hardcore here. Admittedly, this is now stabilized to the point where you could either buy it at support or sell it at resistance. I don't have any problem with buying it lower, but right now I prefer to sell it higher. I don't think this dollar, in other words, right now we have dollar weakness. I don't know if that's going to last. I think they're a little bit excited about this PPI, right? But they're going to be excited about this PPI for 2 hours or so, right? And then what's going to happen? They're going to get worried about North Korea again, and then ironically, they're going to buy dollars. If they're scared, right, they're going to want to own treasuries, which is a moot point, in the end, because like if there is a war, I don't know, this whole thing is nuts, right? But we created this situation here in the U.S. You know how we created it? By giving into these clowns at every time they acted this way, we gave into them. That's how we created this situation. And now, for once, we're not giving into them. Every time they act like a spoiled brat, we would give in to them and give them something. And for once, we're not doing that. And now it creates a problem. But we created the situation by giving in to them constantly. And, that's how this whole thing began. And in my opinion. Anyway, opinions don't matter right now. But the thing is like, you're going to buy, people are buying treasuries because they're afraid there's going to be a nuclear war. Well, if there's a nuclear war, does it really matter? Well, I mean, yeah, okay, he's a lunatic, but it's obviously a plan. I mean, his dad was the same way. I mean, They can't all be lunatics, right? Can they? I guess they could. I guess it's possible, but I have a feeling it's more of it's a studied approach, Hey, everyone, I'm crazy. Look at me. I mean, if you're really a lunatic, don't you just launch the bombs? I mean, if you're really, truly crazy, don't you just fire the missile? Yeah, using nuclear leverage is crazy, but if you're really crazy, it's yeah, it's the world we live in. It's the world we live in. Okay. Anyway, yeah, I don't have any problem with you buying this, but I prefer to sell it right now. But here's the thing, right? The beautiful thing is this, right? But this goes back to the Mark Douglas, the 5 fundamental truths, right? I don't know if it's going to drop down to where you can buy it, and I don't know if it's going to rise up to where I can sell it. But I don't have to commit to either one of those. I could say if it drops down, I can buy it, or if it rises up, I can sell it, right? And I don't know which way it's going to go. I don't have to know which way it's going to go to make money. I could say if it comes up to 131, I'll sell short. If it drops down to 128.80, I'll go long. And and that's it. Maybe that's the way to play it, right? I don't have to make that commitment, right? And that's the beautiful thing about this. Anyway, we got to look at the yen pairs, because this is the thing, right? You would think that with the lack of inflation, dollar falling, you would think stocks would like that news, because what you're saying really is no more rate hikes, good for stocks, right? Lack of rate hikes, that's good news for stocks. But stocks are getting hammered here. They're getting the beat down. And that's really good news for the yen, usually. Look at this. This is quite the trend we've got going on here with the Japanese yen. Look at that head and shoulders at the top. Sliding down the 10-day moving average, as is so common right now on so many pairs. Of course, it does not work on every pair. It has not worked. It failed on the euro yesterday, but it seems to be working fine here on dollar yen. And this is the one that could really accelerate. If stocks hit a rough spot here, the yen could really take off. And if you look at this, I'm going to show you the weekly. This could really fall a long way. If you look at this, could it really come down here? It absolutely could come a long way down. There's a lot of empty space down to 100. 100, I mean, there's a little bit of support here, but really 100 is the big support level. And you're just below 110 right now. That's almost 1,000 pips away to 100. Long way down. If we start getting down there, you're going to start hearing them talk about intervention. That could be pretty interesting as well, right? So I would be looking to slide this one on the 10-day, right? Which right now is located at 110.43. So once again, here we go again, gang. 10-day moving average, but this time, right, last time we did this successfully was with Aussie yen, and we were shorting the Japanese yen. This time, it would be a case of buying the Japanese yen against the US dollar. Now, let's see if it's happening on any of the other yen pairs. Let's take a look at euro yen. Euro yen, No, but this could be an important breakdown on euro yen. Euro yen is just breaking down here. And this could be kind of a big deal because doesn't it look like it just jumped off a cliff? Look at this. Forget about the moving average for a second, and it's like cliff diving right there. Like, look at this thing. It just climbed. What is that? Like 1,500 pips, and just said Geronimo, like right over the edge. Look out below, perhaps, right? That could be a big move down. I think that could be very shortable on rallies on euro yen, but it's not going to be as neat and clean as the dollar yen 10-day moving average. What about pound yen? Somebody called this the widowmaker. I was talking to someone who referred to this as the widowmaker the other day. I guess because it used to be really volatile. It's really not that volatile right now, but it's not adhering to any moving average right now. So I'll just leave this one be for now. Dollar yen looks the most interesting in terms of the 10-day moving average, but that euro yen looks fascinating to me. This is one where, my gosh, that is a fascinating looking chart because that's like this reminds me of that, like you get on that roller coaster and you just clack, 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 and it goes to the very top, clack, 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 and then it goes over the top and it goes over the edge, right? That could be, this could be quite a ride down. I mean, maybe it's nothing, I don't know, but here's why I'm fascinated by this. I'm going to show you a monthly chart of the stock market. Get rid of the moving average. Look at this. Okay. This has pretty much quadrupled. The intraday low, if I remember correctly, yeah, it's around 670. I think it was, yeah, the intraday low is 666 for you for you aficionados of the Omen movies. The intraday low was 666, and now we're pushing 2,500. So that's nearly quadrupled in, I think it's 8.5 years. 8.5 years. So this is ripe. This is the stock market crash before. A little bit of context, gang. Remember the stock market crash of 2008? This is the stock market crash. Remember how bad it was? This is the stock market crash. Look at it now. This was the big crash that was going to take us all down and we were all going to live in caves. Remember that? That was it. Now look at us. Do you think something like that could happen again? There's the opening bell right now. Holy cow, look at this. I mean, right? I mean, this was a devastating event for a lot of people. And now look where we are. Are we vulnerable? Right, is the question, right? And what would happen to the yen, you know, if we began to come down hard? It could be brutal. It could be horrifying. Right? So just a thought, right? Just something to keep in mind. That was the big crash. And this is where we are now. It's a little bit jarring, isn't it? It's a little bit jarring. So that's why I'm thinking about the yen. That's why I have the yen on my mind, because it doesn't take much. It really all it takes really is a loss of confidence. It was 10 years ago this week that, not that the crash began. 10 years ago this week is right around here. It was 10 years ago this week, I believe, that Bear Stearns began to get into trouble. I think, if I remember correctly, there were 3 Bear Stearns hedge funds that needed to be closed because of investments in mortgage-backed securities that had bad loans inside of them, as components of those. And that was the first you heard of it. And people began to say, hey, wait a minute. All these bonds are AAA rated. And if you watch the movie The Big Short, and not too many people were worried about it at that point. They said, a couple hedge funds, had to be went under. But not too many people thought it was going to go beyond that. Right? But just look at it. That was the big crash. This is where Lehman Brothers got taken out. This is where the banks are all getting bailed out. And we only came from here to here. Look where we are now. The market has quadrupled, nearly quadrupled since then. And, one thing that's interesting is, if your money's been in mutual funds, people wonder, well, why has my IRA, why has my 401k not quadrupled? That's a fascinating question. It's because of the fees. And you're thinking, okay, yeah, I'm paying like 2-3% in fees. No, you're paying a lot more than that in fees. The fees are compounding. And that's what they don't tell you in the mutual fund companies. The mutual fund companies love to talk about compounded returns, but they don't really talk about that the fees are also compounding. And that's why the market can quadruple and your account doubled. You're saying, well, I'm glad my account doubled, but the market quadrupled. And so I really feel like my account should have done more than just double over this period of time, this 8-year period. And that's your answer right there. It's because the fees have also quadrupled. And if you want to know more about this, Google this: Frontline Retirement. Frontline is a PBS program. PBS is the public broadcasting. It's like the BBC here in the U.S., right? And so PBS Frontline did a program called The Retirement Gamble, where they explain this quite thoroughly and brutally. And once you've seen it, you cannot unsee it. So just a little something extra for my friends out there. If you really want to understand why your retirement accounts and your 401ks have underperformed the market, it's uncovered by the PBS program Frontline, and it's online for free. You can view it. Just Google Frontline Retirement Gamble, and there you'll have it. Okay? All right. That's going to do it for me. I'm out of here. Thank you very much, Carlos. We'll have a good trip. You're going to see Red Sox Yankees. Boy, that is always a classic. It wasn't until I lived in New York that I realized that's a rivalry. Okay, that's a true rivalry. Richard, thanks very much. It's a very true statement from Richard. Moving averages help us filter the charts no matter what the pattern. And you know what? You can put a moving average on any time frame. I was looking at that. That 10-month moving average actually does look kind of interesting on the S&P 500 chart. So maybe we should be buying the S&P 500 and we'll pull back to the 10-month moving average, which would be quite a pullback. Quite frankly, I think they would call that a correction, all the way down to looks like 2363, right? But yeah, quite an uptrend. But, gosh, hey, we've been going up for 8 years. Maybe we'll go up for 9, 10, 11. I don't know. But at some point, right, this party's going to end. It'll end temporarily. It never seems to end permanently, but it always seems to hit a bump in the road at some point. And gosh, whenever it hits that bump in the road, everybody seems to be lulled to sleep. And, I'm just trying to say, hey, don't let it catch you by surprise. Look at this chart. This was the crash of 2008, and this is where we are. You are here. You are here right now. This was the crash of 2008. That's an eye-opener. Okay, gang, I'm out of here. Everybody have a great day. Enjoy the weekend, and I'll speak to you again, not next week, but the week after. Okay, have a great one. Take care.